Indian equity market has seen a major correction since October 2024. And we have all heard that one of the major reasons for the correction is the FIIs dumping the Indian equity. In Jan 25 itself, the FII outflows stood at a whopping rupees 1.12 lakh crores. So what is the main reason behind the FIIs dumping the Indian stock? So let's look at this chart. It shows a perfect inverse correlation between the US bond yield rise and the fall in the Indian stock market since 2024. Since October 24, the US bond yield has risen to about 4.6% in January 25, despite a 100 basis point cut by the Fed since October 24. So how is it still related to the Indian market fall? Let's deep dive a little bit further. So it's a vicious cycle. Number one, despite Fed rate cut by 100 basis points since October 24, the 10-year US Treasury bond yield has increased to about 4.6% in January 25. Number two, due to increased bond yield, the demand for the US bonds has increased significantly. Number three, this has increased the demand for US dollar, which has been sucked up from the global market to be reinvested in US bonds. Number four, due to high dollar demand, the dollar has appreciated significantly against the Indian rupee. Due to US dollar appreciation against the rupee, the current bond yield has become more attractive to the FIIs than their return on the Indian equity post-tax in US dollar terms. Now, assuming that the FIIs were earning 10% per annum return on Indian equity, their post-tax returns post the dollar conversion comes to around 1 to 2% only, as against the 4.6% returns on the US bonds. Number six, hence the FIIs have been dumping the Indian stocks and taking back their dollars and investing in the US bond market, which is much safer and still lucrative. And the result is the Indian stock market crash. However, it's a matter of time before the long-term yield on the US bonds starts tapering to align to the US Fed rates. So once the US 10-year Treasury bond yield aligns to the US Fed rates, the FIIs should again start pumping in money into the Indian equity market. Remember, the understanding of finance is incomplete without a complete understanding and correct interpretation of economics, especially macroeconomics. For more such insights, subscribe to our channel below and get in touch with a team of experts today.